Hi there everyone, and welcome to this week's market update. Don't forget that any advice contained within this presentation are general only, so it isn't tailored to your particular circumstances. You need to decide for yourself what is appropriate to you. Okay, so at this stage the market is around 72.68. We've just gone into the closeout match for the day. Not much has really changed since last week. We're still stuck between the same sort of band in the market, and that's around that 73.20 level as resistance and 72 as support. We can't seem to get much more buying above that sort of 73, nor can we get much more selling below 72. There's definitely a bit of tug of war happening here in the markets at the moment, where some people are starting to come back in, happy to buy the dip down here. Others are still feeling a little bit sort of cautious about this move. So look, only time's going to tell. At this point I feel that we've seen the worst of the selling. You'd have to have another big bit of news really to get that selling going again, in my view. Anything that we see on the table at the moment, I can't see being enough to really push us much further lower from here. Things are looking a little bit more positive, I feel. Okay, I might be a little bit early here in saying that, but I still feel a turnaround is very close, and we'll probably see ourselves back up near that 76, if not higher, by the end of the year. But really at this standpoint, we're just waiting for that pennant to break. Once we get our breakout, we'll get some confirmation and a few new fresh signals to trade. Alright, so let's get across to the US markets. A sort of similar thing there. Not much has changed in the past week. We're just whipping around in a fairly volatile manner, just at the bottom of this move. Question is that a double bottom? Don't know yet. Just way too early to tell, right? So yeah, just sitting here waiting, guys, for a bit more of a signal of where we're going to go next. Now, the next big catalyst really is going to be US reporting. That kicks off tonight with Fastenal. Fastenal is a good bellwether of the industrial sector, gives a feel on how construction is going, and that's usually a good sort of kick-off for the reporting season. From there, we get a lot of the big US banks every night for the rest of the week, basically. So, yeah, big banks this week, guys. All eyes on that. If they're reporting a little bit better than expectations, then that will help push our market higher and our banks higher as well, especially Macquarie Bank, which follow a very similar model to the banks over into the US there. So yeah, US reporting is the next big catalyst. Most people have downgraded expectations after the previous reporting season in July, and that was really looking at that time COVID cases were on the rise, supply chain issues, which are still having issues now, really put a lot of people had a lot of people worried at the time. So look, expectations have been dropped, therefore there's a very high chance we're going to beat those expectations. We're seeing that quarter by quarter in the US, most quarters beating significantly. Okay, so if that's the case, I suspect that would be enough to sort of take the view away from some of the other things that are happening out there and getting that focus onto the actual earnings season and how expensive stocks or cheap stocks really are out there. The big thing though as well is the reopening sort of story, especially locally here in Australia, where we're rapidly starting to hit vaccination targets, and that also is going to have a positive influence overall on markets. So our national first doses are now over 80%. That means that we should hit nationally second dose within the next month. So that's sounding pretty confident. Sydney is starting, or New South Wales is starting to reopen. Okay, slowly reopen as of this week, and I suspect we'll continue to see more and more reopening in New South Wales in the coming weeks and months as they continue to get higher and higher vaccination rates. Victoria is suggested to hit their target by the end of next week. Okay, that first 70% double dose target. Okay, so that's coming very quickly. So yeah, look, keep an eye on the reopening stocks. Some of them have run a little bit hard already, so a little bit of a pullback in some of those travel stocks will then reopen a new opportunity. Okay, so they're pulling back right now. That's one of the spaces to watch right now, is those travel stocks. Okay, once that bottoms out, there'll be another bite of the cherry there. Look, the Evergrande collapse question mark there, still playing out in the background, guys. Look, that could peer its ugly head again in the coming months. We just don't know. It has shined the light on the issues that China's having in their housing market. So, look, there could be more companies to come. We don't know. We still don't know how China's exactly going to handle this. But I really don't think China can let them collapse. Okay, because like I said, there's many other companies in China that are in a similar situation. And that's going to put their economy at risk. It will also put credit markets around the world at risk, and I just don't think they're going to go there. I don't think they're going to let it happen. But nonetheless, it is one of the many things that have got people a little bit nervous about markets at the moment. The next thing, obviously, is the Fed. The Fed's due to start tapering in November. We don't know how much and how long they're going to take to taper down to zero bond buying, if they even go there. We just really don't know, do we? So they're not due to meet again, the Fed, until early November. So that's roughly 3 weeks from now. So we'll know a bit more when that all plays out. But for now, that's just also another thing in the simmering pot in the background of uncertainties, I guess, for the market. Look, I don't think the tapering is really a big deal. If anything, for me, it's positive, right? If the Fed feels they can start tapering, it means that the economy and the credit markets can start to stand on their own 2 feet and don't need the Fed to provide liquidity. So that's really the most of what that bond buying does, is provide liquidity to the credit markets. US debt ceiling issues, which is sort of tied in with for me on Biden's stimulus and budget plan. Look, the debt ceiling problem's been kicked out to December, so early December at some point, late November. This is going to be a problem again. Okay, so let's just see how this plays out. But there's also something that's simmering in the background. I think for the next couple of weeks, we can easily see focus go on to US reporting, and then say early to mid-November, we'll see focus come back here. Markets are really going to want Biden's stimulus and budget plan pushed through. Okay, they want that $3.5 trillion of spending. They want that infrastructure plan up and running. Okay, markets see that. I think we'll get that next leg up. Okay, so they're the kind of few things that we want to see resolved over the next few months to keep us bullish, right? The spending is the big thing for me. The central banks of the world have done their part. There's not really much more the RBA or the Fed can do to really push the economy forward and really give it that big push out of the COVID lockdowns that we want to see. It needs to come from physical spending, and that's what we're waiting for from the US government at this stage. We probably won't see too much more locally, okay, in the way of aid or anything like that. I think we won't hear much more from the local government until the local federal government, that is, until after the elections next year. Okay, or coming into the elections, we might hear them talk a bit more about their plans. But nonetheless, okay, at this point of time, it is all about the US. That's what we're looking out for. Everyone's talking about inflation and whether that's going to push interest rates up. I can't see that happening, guys. Okay, the inflation we're seeing at the moment is from supply chain issues mainly. Okay, those supply chain issues are likely to clean up over time. Oil up at $80, it could go to 100. Easily in a year or two time, see that back down to 50 or 60 US a ton. You're going to remember OPEC's in the background, eagerly waiting to add supply onto the market, and they're going to be gradually doing that over the next 12 months as well. So look, I think a lot of what we're seeing out there is temporary, okay, in the way of inflation. Some prices will stay up. Not all prices will stay up. When we're talking about commodities and oil, where there's huge markets worldwide, they're fairly efficient, guys. Okay, and they can easily, as it goes up to 100, it can easily come back down to 50. We've seen it time and time again. All right, so look, like I said, the inflation should only be temporary. Interest rates are likely not to go up for quite some time. The RBA is saying 2024. The Fed's, I guess, a bit more split. They're saying that it could go up next year. I don't think you're going to see an interest rate rise from the Fed next year either, to be honest. All right, that's just my view. All right, so that's where we're at, guys. Look, like I said, there's just so many things up in the air right now. The market's still a little bit nervous, but that's why we're seeing a bit of volatility in this whippy nature at the moment. We need a new catalyst. We need something to take the focus away from the debt ceiling issue, the budget plan issues in the US, the Evergrande issues in China, and distract investors for a little while in looking at the earnings. And I think that's what we're going to see over the next 2 weeks, 3 weeks, 4 weeks, is focus really wholly and solely going on to US reporting, and then we'll very quickly switch back at some point through November to these other issues. All right, so that's where we're at. Thanks for listening in this week. Take care and bye for now.